You know, some of the most disruptive garage-based startup inventions of our time are actually being secretly bankrolled by the oldest corporations on Earth. Welcome to The Explainer, where today we are exploring the fascinating world of corporate venture capital to really understand how massive corporations fuel startup innovation. If you look at the technological leaps defining our modern era, from life-saving medical devices to the digital infrastructure of global finance, you might assume they were entirely the product of independent rogue startup founders. But actually, operating quietly right behind the scenes is a massive, highly strategic financial engine driven by some of the most established companies in the world.
So let's start with a really provocative question. What drives traditional, rigid corporate giants to invest so heavily in agile, high-risk startups? It kind of seems counterintuitive at first, right? After all, large corporations have their own massive research and development divisions. Why look outside the building? Well, the answer lies in the fundamental need to survive and adapt in rapidly changing markets. Corporations are actively seeking external innovation to avoid disruption, and they do this by forming a bridge between their own vast resources and the lightning-fast execution of a startup. Chapter 1. Decoding Corporate Venture Capital.
Okay, so what exactly is this engine of innovation? Corporate venture capital, or CVC, involves direct investment straight from a corporation's balance sheet into an external startup. It's a totally unique hybrid of corporate resources and startup culture. Crucially, it is not an investment made through an external fund managed by a third party. When a company engages in corporate venturing, they are taking a direct equity stake in an early stage or scale-up company. This creates a really fascinating dynamic. It forces the careful, risk-averse nature of a traditional corporation to interact directly with the high-speed, unpredictable culture of an entrepreneurial venture. Managing this successfully is notoriously difficult, but as you'll see, the potential rewards are absolutely immense.
Chapter 2. Strategic versus Financial Goals.
Let's dive into why they actually do this. When we look at the data, over half of these firms, 54% in Europe and 50% in the US, invest primarily for strategic reasons. Unlike an independent venture capitalist who's looking almost entirely for massive financial returns, a corporate division wants a window into new technologies. They want a way to enter new markets or a method to identify future acquisition targets. Now, they certainly still expect financial returns from these startups, but strategic synergy ultimately leads the charge. They are literally leveraging their cash to buy a front-row seat to the future of their industry.
To pull this off, firms basically use two different playbooks: driving investments and emergent investments. Driving investments have a tight strategic alignment with the corporation's current business. They basically roll right into the current strategy to advance it, hitting the gas on what they already do. Emergent investments, on the other hand, are super interesting. They act as strategic scouting missions into entirely new markets. They don't promote current strategies, but they remain tightly linked to the investing company's broader operations. They act as a sort of option strategy. If the business environment suddenly shifts, these emergent investments into untapped markets could instantly become strategically vital, providing critical data and a solid foothold in the future.
Chapter 3. The Startup Financing Journey.
So how does this actually play out over time? Startups progress through a rigorous, multi-year journey. It starts with early-stage financing to develop a concept and a prototype. Then comes seed capital, and here's a wild stat. Corporate ventures know that only about 20% of companies will successfully make it past this stage to the next round. If a startup does prove itself, it moves to expansion financing, usually securing $1 to $10 million to recruit staff and cover negative cash flows. Ultimately, the goal is an exit event, like an initial public offering or a merger and acquisition, usually around year 4 to 7, where the corporate investor can finally realize a return on their patience and capital.
But getting that cash is definitely not a walk in the park. Founders have to successfully navigate a highly structured dance of term sheets, lockup periods, and intense corporate due diligence. After the initial pitch, if the corporate investor is hooked, they issue a valuation and a term sheet. During the legal negotiations, a lockup period is heavily enforced, which basically stops the startup from talking to other potential investors. And during this time, the corporate team digs incredibly deep into the startup's books, their financial statements, projected performance, and they even interrogate their customer base before finally closing the whole shebang.
Chapter 4. Impact across global industries. But how does this invisible hand of finance actually shape the stuff you and I interact with every single day? Well, unlike traditional independent VCs who focus heavily on software and medical devices, corporate venturers have carved out their own distinct domains of influence. They heavily dominate sectors like biotechnology, telecommunications, semiconductors, and media. By injecting billions of dollars into these specific areas, major corporations are actively dictating the pace of technological revolution, transforming everything from the microchips in our phones to the entertainment we consume. Take healthcare, for example.
Giants like Johnson & Johnson and Ascension Health use CVCs to discover life-saving medical devices and treatments that perfectly complement their own product lines. Historically, billions of venture capital dollars have targeted specific diseases, with nearly $15 billion dedicated to cardiovascular diseases and another $14.7 billion to cancer research. But corporate venture arms in this sector operate uniquely. They're highly strategic. They're looking to improve their own manufacturing processes or complement existing treatments, all while generally aiming to remain completely budget neutral for their massive parent organizations.
And we see this dynamic everywhere else too. For instance, in the media sector, the South Africa-based company Naspers used strategic corporate venturing to survive the digital revolution, ultimately expanding to operate in more than 127 countries. It's a real game changer. Meanwhile, over in the energy sector, traditional oil majors like Chevron and chemical giants like Dow are investing heavily in clean technology, water technologies, and alternative energy. They are literally funding the transition to prepare for a world that relies heavily on sustainable infrastructure.
Chapter 5. Case Study, Deutsche Bank.
Let's ground this with a highly detailed, real-world case study, Deutsche Bank. They operate a massive cross-divisional program that goes way beyond just writing checks. They utilize a distinct three-pillar approach. First, they invest in early to growth stage companies. Second, they create and incubate. This literally brings talented entrepreneurs in residence, physically and operationally alongside Deutsche Bank experts to build independent businesses from scratch. And third, they grow these companies through active business development, assigning a dedicated manager to help the startup navigate the notoriously complex financial industry. So what are they actually funding? Their investments are fiercely strategic, targeting enterprise solutions like artificial intelligence, cloud technology, cybersecurity, and digital assets. It's almost surprising to think about a traditional, centuries-old banking institution funding cutting-edge tokenization technologies, essentially using blockchain to securely digitize and manage assets. But that is exactly what they are doing. This ensures that every single investment has a direct pathway to improve the bank's operational efficiency or upgrade their overall client offerings.
And from the startup's perspective, well, as Tana Technology CEO Maria Scott highlights, this kind of corporate partnership provides startups with the ultimate golden standard of validation and global reach. When a startup partners with a major institution, they aren't just getting a big influx of money. They're getting an incredibly powerful testing ground. They get access to industry specialists, regulatory expertise, and an immediate global footprint. For a startup, this means maturing their product in partnership with the very teams that will ultimately deploy their technology on a massive global scale.
Chapter 6. The Future of Innovation.
So what does this massive corporate influx mean for the future? Well, as markets fluctuate, we are seeing a fascinating rise in David and Goliath partnerships. Instead of just relying on liquid funds, corporations and startups are increasingly trading shared technologies and data. This trend, which is especially noticeable in the healthcare industry, involves strategic partnerships based on the exchange of vital, proprietary information. When liquid capital is scarce, they form a corporate in-kind investment. They complement each other perfectly, right? The startup brings raw, disruptive technology, and the giant brings process information, scale, and the massive distribution network to actually sell it.
Which leaves us with a final thought. As the lines between independent ventures and corporate giants continue to blur, who will truly pioneer our future? Corporate venture capital proves that innovation isn't just about rogue disruption, it's heavily reliant on deeply strategic collaboration. The companies that build tomorrow's world will likely be the ones that master this delicate balance of corporate might and entrepreneurial speed. Thank you for joining us on this explainer. Keep questioning, keep learning, and we'll see you next time.